So let's talk about some tax planning strategies if you think you're going to have higher taxes in retirement. So what are some options there? Let's just talk about what that means. So if your income is going to be higher than it is today, if we think tax rates are going to be higher than they are today, then these are some strategies that you want to pay attention to. You want to contribute more to tax favored, right? That's where you get the income comes out tax free as long as it's structured properly. So some examples of that would be Roth IRAs, cash value life insurance. You pay taxes today, and this is so you can enjoy that tax-free income in retirement. So the accounts you choose for your retirement income, that's going to depend on where you think your tax rate's going to be when you're retired. So if you think your tax rate in retirement is going to be higher today, either because tax rates go up or because your income will be higher, then you should put more into these tax-favored accounts. This way, you're paying taxes today, and then you get to enjoy that tax-free income in retirement. The other thing I'm going to say about tax-free income is I can tell you when I'm talking with clients in retirement and we're talking about, hey, like the client I talked to yesterday is putting in like a new front porch. And so she's like, hey, where should I pull this from to pay for it? And so we looked at all her options she had available to her. And one thing I find is that when people have money in those tax deferred accounts, even though the money's there, even though it's available to them, even though that money is designed to provide them an income in retirement, the taxes cause people to think twice about taking the money out. So even though they have it there, they're like, oh gosh, I don't want to take it out because I don't want to pay the taxes. So it like almost locks it up in jail, locks it up in prison because you just don't want to have to pay the taxes. Or because you have to take out so much more because of the taxes to even do what you want to do, right? So that's where those like tax favored accounts come in, and people say, hey, I need some money to go take a trip, or I'm going to go take some money out I need a new car. We're going to remodel the house, like whatever it is. If they're like, oh, this isn't going to impact me from a tax standpoint, they're much more likely to actually do that. All right. You're much more likely to actually take that money out to do those things. Now, what if, on the other hand, you think that your tax rates are going to be lower in retirement? So tax planning strategies for lower taxes in retirement. So how do I have lower taxes in retirement than I do today? Well, my income could be lower or tax rates go down. So I would not plan on tax rates going down. I think we could plan more for them either staying where they are or going up. But then you really need to look at your retirement income to see will your income be lower in retirement. That is not true for most of my clients, but yes, we obviously have clients where that's the case. I have a client who has really been in higher education her whole life, but she doesn't have a pension plan. So everything is in like a 403B equivalent. She is going to have less income in retirement than she does today, right? So these are the strategies that apply to her. And what we want to do is we actually want to contribute more to those tax deferred accounts. So if my income is going to be lower, my tax rates are going to be lower, then today I want to contribute more to those tax deferred accounts. That's traditional IRAs, employer sponsored retirement accounts, 401ks, 403Bs, 457s, right? All those kind of workplace plans. Because I want to take advantage of the tax deduction today. If my taxes are going to be less in the future, then how do I lower my taxes today? So I can defer. This is when it's good to defer. And so I take advantage of the tax deduction today, and then I'm going to pay taxes on taking that money out in the future. Now, this is not, again, one size fits all. You can see how this has to be individualized, and I can't just blanketly say everybody should do this because everyone's situation is different. So this is when we want to do some tax planning so we can understand where we are today and what is this going to start to look like for us in retirement. And then we want to be able to adapt and make changes as we go. All right, so let's kind of get into this a little bit more in detail and go through and talk about these different types of retirement plans and retirement accounts. And I want to talk about some alternatives. So most people think of retirement plans, they think of that employer-sponsored plan. Some people think of it a 401k. If you're with like the state, county, education, some sort of nonprofit like a hospital, then you might have a 403B or a 457 plan. And that's, again, this is why it's the most common, because it's what we think of when it comes to retirement plans. But there are a lot of alternatives, right? CDs, mutual funds, muni bonds, IRAs, Roth IRAs, cash value life insurance. There's a lot of choices that we have. And there's really two strategies that I find that are overlooked, which we're going to talk more about today, which are Roth IRAs and then permanent life insurance, like whole life insurance. And so we're going to go into how both of those work and the tax implications and how they might apply to your situation. But before we get there, I want to look at the impact of taxes and why this can be so impactful. So again, tax diversification means that your money is in different types of accounts. So this strategy gives you flexibility and choice in determining how you're going to be taxed in retirement. So let me give you an example of how this might play out. So let's say that one client is going to take out $100,000 from their 401k, and they're after age 59 and a half, so don't have to worry about any penalties. What would the tax impact be? Now, we're assuming that this person is in like a 32% tax bracket. It doesn't really matter what the tax bracket is. It works on all brackets, but let's just say 32. This means they've already got a good income coming in, probably from like, let's say 2 Social Securities, 2 pensions, what have you. And if they take out $100,000 from the 401k, then, and they're in the 32% bracket, they're going to pay $32,000 in taxes. And that's going to leave them with $68,000 left as like net income cash flow for them to spend. And then let's compare that with another option of saying, what if they took half out of the 401k, so $50,000 out of the 401k, and then $50,000 out of a tax favored asset? That could be a Roth IRA, that could be cash value life insurance. So now half, which is going to be $50,000, is taxed at 32%, and the other $50,000, there's no taxes. So we get the same cash flow, $100,000 out, but we only pay $16,000 in taxes, not $32,000. That's a huge difference, huge difference, And again, like I said, you might be thinking, well, April, I'm not in the 32% tax bracket, and I get that, but it works no matter what bracket you're in. If you're in a 22% bracket, then think about that. So you would pay 22% on half, and then the other half would not be taxable, and it would still reduce your taxes by half. It still cuts the taxes down in half. This is why it makes such a big difference. It's the same cash flow, right? This is what we want. We want to have the same income, if not more, but we want to pay less in taxes, right? How can we have the best of both worlds?